How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you all to today's live trading event, the Non-Farm Payrolls Report. Please indicate on the screen whether you can hear my voice, see the opening slide, and we'll begin immediately. Just a simple greeting, hello, something to acknowledge that I'm not speaking out here into the ether alone. And, oh, great guy, thank you very much. Hello, how do you do? Welcome to today's session. And Sandy, Vivian, great. All good to see you all. All right, ladies and gentlemen, that's a good enough proxy for me. We're going to get underway. I'm your host, Seth Julian. I'm a registered licensed securities dealer out of the Cyprus Securities and Exchange Commission. I'm the Chief Global Analyst here at Alvexo Trading. 64 years old. I've been trading in, how do you CCO? Some CCO. I've been trading for 51 years now, and I'm particularly fond of the Non-Farm Payroll Report. So we're going to dive into this immediately. Just a couple of public service announcements. We're trying to improve our services, so I want to mention that there's a poll and a survey that I'd like you to fill out at the conclusion of today's session. Gives your opinions. We're trying to gather some information as to what's good for you vis-a-vis time of day and subject matter, et cetera. So kindly give us a few minutes and fill that out. That would be very helpful. Of course, I want to mention as a promotion that our next session is on the 12th of May, the 1900 GMT. We're going to be talking about how to transform news into trades. So with that, ladies and gentlemen, let us get underway straight away. There is one protocol I want to share with you, and that is you are asked humbly to please put all of your questions up on the question and answer area so we can deal with them online, and it adds a dialogue effect as opposed to the coma-inducing monologue effect, which surely we don't want to induce. So what's the Non-Farm Payroll Report? Yes, again, just yes, of course, that's right, Barbara. Please, just, I don't want anybody to feel intimidated or inhibited in any way. There are no dumb questions. We respect the questioning process. It's a sign of commitment to what we're doing here. So what's the Non-Farm Payroll Report? It's a total of the number of jobs added to or subtracted from the U.S. economy over the last month, net of farm workers, hence the silly name. Now, why is it important? It's because it provides an important indicator of health of the world's largest economy. It's the most widely followed event on the monthly economic calendar, bar none. Now, the results of the outcome, the effects, if the result is approximately equal to or better than the expectation, the US dollar is likely to gain strength. If the result is less than expectation, the US dollar is likely to weaken. Okay, notice the red, bold, italic, underlined word likely. It's there for a reason. There's risk here, ladies and gentlemen. And the risk is that the unexpected will happen. That's exactly the definition of risk, that the unexpected happens. And while we are going to go into the mechanics of and the expectations for the outcomes of these reports, beware that sometimes they don't work out as expected. And I'll go into exactly how they don't work out as expected on rare occasion as we continue. But assuming they do go according to expectation, we can exploit these results by first and foremost waiting to see the true market react to the outcome, not the knee-jerk reaction. In other words, if the report comes out positive, we're expecting 390,000 jobs to be added. If it comes out approximately, we're not going to just immediately launch into a strong dollar trade. We're going to wait and see how the market reacts, because that's one of the ways it doesn't react according to the outcome. You get the result you expect, and the market blows it off, doesn't care, doesn't seem to react, and there's no trade. Because at the end of the day, we're not trading the report, we're trading the market. So the idea is not waiting for the market reaction and not the knee-jerk reaction. We trade along with a trend that can stay in trend for a few minutes to several days or more. And those of you who've been with us recently know that of the last, let's call it 5-6 months, 4 of those months have been really, va-va-va-voom trades, fabulous trades that have lasted well into the next week. So one could trade 6 currency pairs during the event. Let's look at the potential setup. We'll get to those, but those are just examples of other things. Now, this is the most important screen, particularly for the newcomers. I want you to understand full well what you need to understand in order to profit, in order to exploit the opportunity. In the event of a positive outcome, okay, the direction of the dollar on the right pairs is going to go down. And in the case of the dollar on the left pairs, they're going to go up. Let's understand this clearly. This line, it's not written here, but sometimes it's the Aussie dollar, euro dollar, pound dollar is often a slash mark in there. Means that it's a ratio, it's a proportion of the right-hand element to the left-hand element, which is often called the base currency. Why? Because the exponent of that right-hand currency or asset, whatever it is always 1. And in oil or gold or cotton or anything else, it's always 1, in the case of oil, barrel per US dollar. And so the exponent of that right-hand variable is the one that moves on the horizontal or the y-axis of the graph. So as the dollar strengthens, it takes less dollars to buy the same 1 Aussie. So hence, the strengthened Aussie dollar pair will go down. That is to say, the strengthened dollar in the Aussie dollar pair will go down. Just like in gold. When gold strengthens, when gold strengthens, it would be gold versus, it goes up because it's going to cost more dollars to buy the 1 troy ounce of gold. And similarly, or conversely, I should say, in the case where the dollar is the left-hand, as the dollar strengthens, it's going to take more yen or more Swissy or more loonie to buy the singular US dollar. I hope that's clear to everyone because it's the essential mechanism of exploiting this live trade. And the reason I dwell on it so is because in live trading events, it's very easy to misexecute. I've been trading them for decades, and I still find them exciting and fun and often lucrative. And yet you have to keep your head screwed on fairly tightly not to misexecute because it is so much fun and exciting. So just for the sake of thoroughness, in the case where the outcome is negative, it's the opposite. The dollar weakens, and therefore it takes more dollars to buy the singular Aussie, and hence the Aussie dollar, euro dollar, pound dollar pairs will go up. They're buy positions, they're called. And vice versa with the dollar on the left. It's going to take fewer yen to buy the same dollar, fewer Swissy, fewer yen. All right, that's, if you come away with nothing from this session, I want you to make sure you've got this this mechanism under your belts. Now let's just take a look at a couple of these other things. This is just some data from the Forex factory sites, all the same on investing.com. Gives you some background, what it is, what comprises it, how it's some past data. There's also some histograms, which are always good to view history. It shows you this, of course, is the great financial crash, GFC, 2008, 2009, and so on and so forth. This, of course, is a picture of the trading platform, and I want you to be aware of this as well, because when we trade, this is taken from my favorites section, and I have them reasonably set up so they're dollar on the right, dollar on the left, with the exclusion of the euro dollar. For some reason, I just can't get it to behave otherwise. But at least it gives me a fairly rigid framework in order to know when things go the way, when I want to sell and buy, I will not misexecute and buy when I mean to sell. This is just an example of a case where we did fairly nicely on trades that we actually held over the weekend. We entered them on the 2nd and left them on the 5th. And even despite and my point is, despite the fact that holding trades over the weekend is an expensive proposition, it still pays. And some of these trades where it's really, really vigorous and robust, it pays very nicely to hold them over the weekend, despite their expense. Now, let me just say, it's always my practice to state very clearly and unequivocally that there's risk in this particular trading event, as there is in all capital market activity. period. And I say this not only because the regulations under which we as a firm and I as a registered securities dealer operate obliges us, but also as someone who has long experience in the capital markets, I well understand that particularly for beginners, the lure of fast and easy profits can quickly shatter on the rocks of market fickleness. And that's what I was referring to with the fact, in the fact that markets don't often, occasionally, don't react in the proscribed expected way. Um, uh, the trades that one enters on to exploit the non-farm payroll have a high likelihood of transpiring according to the expectation. I don't deny that, and I don't pretend to. Meaning that the cause and effect between the outcome of the report and the market's reaction to that outcome are likely to occur in the way one anticipates they will. However, they sometimes don't. That is the risk in all capital market activity, the probability of the unexpected occurring. This is the very definition of risk, and occur it does. The reason we wait a few seconds or more after the release of the report to enter positions is precisely to witness the market's reaction. This is so because sometimes the market simply does not react in the expected way. There are no two ways about this. These are human beings participating in an entirely human undertaking. Now, contrary to the visage that is often presented among the commentariat and the financial media and all sorts of outlets that will present you with scenes like this, and these are the graphs I use. I don't pretend that they look utterly scientific, and they're the same graphs that the engineering and the scientific community use. They don't graph the same things. What these people are graphing is physics or geology or seismology that are hard science. When you know something, it's a deterministic world, and on that determination, you can make calculations upon which you can build edifices and cities and grand undertakings, whole civilizations. This is not the case here. This is a graph of human emotion. That's all it is. Yes, it's a graph of oil, the price of oil, but what it really is there's no absolute price to oil. It's the graph of human valuation of the price of oil. Economics and finance are social sciences because they attempt to understand a human enterprise. Humans are emotional, irrational, erratic, and often do not act in their own economic interests, contrary to the often insipid orthodoxy of classical economics. Classical economics is to some degree, I won't say largely, but to some extent full of shit. It says things that are ridiculous. Economic actors always act in their own interests, or the market knows all the prices, and the markets include all information. This is all standard nonsense, and you have to know how to distill out the nonsense. And economics has some value, but its value as a predictive tool in human behavior is highly overrated. So therefore, there's a significant element of risk in their behaviors as individuals and their collective behavior as a market. The herd instinct, where creatures follow other creatures for the simple fact that they have to, that few creatures in this herd are able to see ahead and know where predators lie, where water holes lie, where topographic risks lie, etc., is the most precise unifying principle explaining the market's behavior. It's a herding instinct. It's a mob mentality, mob in a denigrating way, not a violent mob, merely that it's a following along effect. Get the graphs, charts, indicators, and algorithms that economics voices as deterministic tools of trade. They're not deterministic. They are probabilistic. That means that we can say that under particular circumstances, say the NFP report, we expect the market to behave in a certain way with a certain probability. In other words, when X occurs, 8 out of 10 times Y will happen. Will not happen 10 out of 10 times, nor can we be sure which of the 10 times will behave like the 8. Risk doesn't always have a familiar face, ladies and gentlemen. Are there any questions on this subject? If not, and please feel free to ask them, I'm going to switch now to some live screens, and we'll start to take a look at what's going on in the market. So, let me just read the line here. This is a this is a screen of the investing.com website on the economic. It's very similar here. We're expecting 391 on the non-farm payroll. The Forex Factory is expecting 390. You get the idea. It's pretty similar. And the idea is that should we get 391 approximately, the dollar is likely to strengthen, and vice versa. If we get significantly less, if we get 388 or 387, I don't expect that. I think it's still going to strengthen the dollar. But if we get 320, and certainly a lot less than that, we're going to see likely to see a weakness in the dollar. All right. Now, I do want to add an additional note. We are in an extraordinary, and I say extraordinary because we are seeing inflation that we haven't seen in nearly 40 years. I last saw it, the world last saw it in the developed world in the early 1980s as the Vietnam War's inflation came home to roost and devalued the United States dollar by 20% and forced U.S. interest rates up to the unprecedented 21% interest rate under Chairman Volcker at the Fed and under Reagan, which caused other economic revolutions at the time too, Reaganism, Thatcherism, etc. I'm not going to go into that now, but these were really, really earth-moving in the world of finance and economics. And we are in a similar period now. There's no two ways about it. The Fed is late. The banks, all the central banks of the world are late. Inflation is going to get much higher before they get a handle on it. Don't make any mistake about that. They're just always behind the curve. Nothing is transitory. This was all nonsense that they foisted on us because they really didn't know, or they were afraid of acting, or they were too, whatever it was, they were late and they're always late. And this inflation is going to cause some serious disruption. Let me just point this to you. See this? This is yesterday's close on the S&P 500 in heat map version. This shows us who lost what yesterday in yesterday's trade. Amazon 7.5, Tesla 8.33, Facebook 6 3/4. Massive sell-offs in these assets because the idea is starting to take hold among the trading community that we're into some very deep shit here. The inflation rate is rising swiftly. The interest rate is going to have to rise commensurately to even try to arrest it, so they're behind the eight. Interest rate is notoriously bad. Higher interest rate is notoriously bad for stocks. And I'll show you just one last indicator of what's going on. You don't see this much either. Here is the price of bonds, the U.S. 10-year and the German government 10-year. These are significantly strong downtrends, and they're likely to continue as the price of these bonds falls in the face of rising inflation. So that's just by way of slight background. I do want to show you this. This is the NFP pairs. This is what we're going to switch to. Let me actually, I'm skipping ahead. Let me show you what the order of battle is to be. We're going to wait until the report prints. As soon as the report prints, we'll take a look then at the actual market reaction. These are 1-minute assets we're going to be trading. Aussie dollar, euro, pound, yen dollar. Now, there's always a lot of nervous energy right before the release. We're talking about T-minus 11 minutes and counting. The nervous energy and the positions that are taken prior to the release of the report are invariably the rookies and the newbies trying to second guess and outguess and lead the market. They don't know what they're doing. We never follow them. They always lose. We wait until there's a trend that's visible and is likely to stay in trend long enough to make some money. And that's the second of the possibilities that don't or that occur that nullify the ability to exploit the outcome. Let's say again the report comes out close to them, or even way better than the expectation. And 391 is a huge number. If we have a little time, well, let's just take a moment to look at what that means. The problem with looking at histogram is this. This is March of 2020, where we lost 20 million jobs. 20 million jobs were lost. No, sorry, this is, yeah, March. No, this is a huge amount of jobs lost. And so it skews the whole graph. When you eliminate that data point, you can see how huge these numbers are. 1,800,000. And if we go back to, again, and I'll show you the whole data set without March 20th. This goes back to 1970, but let's leave out this. You see this? We rarely see anything about 400,000. 391,000 is a high point. This is 230. Where is it? You can't see. So this is 230 after the recovery, the initial recovery phase of the great financial crash. What is this? This is, can't really see, but it's 1983. This is when things start to recover after the second OPEC oil embargo. Things start to recover, but there was a long recession after that. So to put it into context, we see that there's quite a significant contribution to the workforce. Nonetheless, we still wait to see what it's going to be, or what the reaction is. Not going to be what it is. Another risk that we face is, oh yeah, there is also this risk. And the market reacts in the absolute wrong way, goes the other way. For whatever reason, even if the trend is strong and stays in trend, I stay away. Even though it looks tradable. That's just, obviously welcome to do trade as you see fit, but in a circumstance that I don't understand, place my hard money, earned money at risk. Another risk, a very minor one, I haven't really seen this occur in years, literally years, as modern servers improve and telecommunications improves, the possibility of the servers jamming up really, it exists, but I haven't seen it in so many years, it's almost not even worth mentioning. However, it can occur that in the case of a very, very robust movement where there's a great deal of surge among traders at our house or any other house, and the servers jam up and you can't get a fill. It happens. It hasn't happened in a long time, but it can happen. That's the other risk. So those are the risks that we face. We've got ourselves 7 minutes till release. Any questions? Let's open the floor up to some questions, ladies and gentlemen. Quiet crowd today. Nobody has any opinions or questions? Anything untold or unexplained? Feel free. This is your chance. Can you look at longer time frames than 1 minute? Asks D. Sure, you can. And excuse me. The reason I look at the 1 minute, D, is because it filters out and it shows us exactly what the market reactions. Normally, if you look at any of my other charts, they're all daily or 4 hours. Those are my two favorite time frames. But we look at the 1 minute, but because this is a live event and we have to only take it into consideration what happens after the report release. So that's why. But once we're into the trade, once things are going, we may, we certainly could take a longer perspective. How do you decide on which currency to trade once the report is out? Asks Goa. Easy. These are just the majors. These are the ones in the case where the dollar is significantly strengthened or weakened are most likely to be affected. That's all. There may be others, but there's only so much you can focus on in a live event. You have limited amount of time, limited attention, and these are the ones that are the big movers. So D asks again, if the US dollar is weak, the US dollar CAD will go up? No, If the US dollar is weak, the dollar CAD will go down, sir. Well, ma'am, I don't know what D stands for. Again, let's take a quick look. If we take a look at dollar CAD, the dollar weakens. The report comes out negative. The dollar weakens, and therefore it takes fewer CAD loonies to buy that $1. If the dollar strengthened, it would take more loonies to buy that dollar, hence it would go up. Is that clear, D? I'm glad you asked. I'm sure other people have the same question. Wendy says, this is great so far. Thank you, Seth, and I love that Bostonian accent. Wendy, wow, I'm touched. I'm really touched there, Wendy. Thank you. Are you a Bostonian? Wow, thank you. Thank you for the compliment. I do remind you again, ladies and gentlemen, we have the polls and the surveys at the end. Please take a few minutes and fill them out. They're valuable to us. We're making an effort to improve these. We have the next presentation on Thursday, the 12th at 1900 GMT, where we're going to discuss transforming news into trades. And this is a fruitful field to till these days, because there's a hell of a lot of news, and much of it is deeply affects the market. Wow, no, Wendy says I'm Zimbabwean, but living in the UK. My only exposure to the Boston accent is family. It's Family Guy. Well, I'll take that as a compliment, by the way, because Family Guy takes place in Providence, and they have the same goober accent that the Bostonians. Peter Griffith, of course, is, I've toned down my accent over the years, but when my brothers and I get together, we sound exactly like Peter Griffith. It's true. So we're talking about T-minus 27 minutes and counting. And so, again, we're expecting 391. Lewis asks, well, I'm 17 and I'm French. I don't have many questions. I'm trying to understand everything you're saying. But what you are saying is very interesting. Thank you very much, Louis. Thank you very much. It's a generous compliment, and I appreciate it very much. So here we go. We've got T-minus 2 minutes and counting, and we're expecting 391. It's a lot. Now, oh yes, and Vivian asks, what do I expect to happen? I don't anticipate. That's the beauty of trading a live event. I don't have to anticipate anything. I just sit and look and watch. In my opinion, to try to outguess, and that's why you see the nervous. I bet you we already start to see them now. No, it's fairly calm. It's fairly calm. See, well, here now the Aussie dollar, it's trading up. It's trading up. You see a lot of the rookies and the newbies trying to outguess what's going to happen. They figure, oh, it's going to be whatever they think. Who cares what they think? It's irrelevant to us, because we don't really, because the last people we want to follow are those traders. In fact, my advice is to never follow other traders. Follow your own trade. Now, you don't understand why you're doing something, or, you don't have the emotional commitment to it, and you're not likely to sustain. You're not likely to have the staying power, the stamina is what I mean, to be able to maintain the position. And that's the subject that I deal with in a number of different contexts in the sessions that we have. So you're always invited to join in and learn something new. So T-minus 1 minute and counting. For those of you who are new at this is the longest minute of the calendar month. Okay, it seems to take about 15 minutes for it to pass. So and there's always a little latency between it's not exact. It's not exact, and you're not normally aware of that until you're actually seeing an event that's clock based, and then you see really what that latency is. So T-minus less than a minute and counting. We're expecting 391. If it jumps radically, we'll try and get into those positions quickly. Let me just make sure that my trade platform is all set up. Yep, it's okay. Sometimes you get that whirly gig, and that can glom things up, but no, so far so good. Okay, here we go. 482. Seriously positive report. Seriously positive report. The dollar yen, which is a great trade. See the way it popped the wrong way? Dollar yen should go up. Dollar Swiss should go up, yet it's going down. Aussie dollar, see the way they're popping in the wrong direction. I don't get it. Let me just make sure I didn't read it wrong. 482,000 as opposed to 391. It's I thought 482, but 420. It's still significantly positive. Why are we getting inverse reactions? The dollar is weakening against the Aussie. What the hell is this? This shouldn't last long. Definitely do not trade along with this. This makes no sense at all. It's absolutely inverse. I haven't seen anything this perverted in quite some time. My suspicion is that it's going to reverse. Remember, these are 1 minute charts, so it doesn't mean anything really, unless it's not likely to persist. You see, they're all reversing now. Would I get into them now? No, I wouldn't get into them until they approach somewhere close to where we were. And they are. The dollar CAD is approaching liftoff. Wow, this is a very, very queer outcome. Dollar CAD looks to me the most promising. Where's dollar, pound dollar? Pound dollar is here. I like pound dollar and dollar yen. They're my best performers. I've made the most money with those over the years in these events. Okay, it's starting to look more normal. It's normalized a little bit. Elias says it's the same as the previous number. You mean the month before, Elias? 491 is 428, 420. Interesting. 420, no particular relevance. It's a coincidence. And those numbers, those previous numbers, are often readjusted. Okay, it's acting weird. It's still trying to do the inverse. It's a good report, and yet it's fooling around here in a way that I certainly am, and no, I will not. There's nothing here for me at all. This is wacky, ladies and gentlemen. It's just I can't explain this. I cannot explain this. And here's the reason, D. We don't want to. We need to be in the minute charts. If you were looking at anything less than 5 minutes, you wouldn't be able to discern a damn thing. Let's make them a little bigger so we can see better. I've never seen. No, I haven't. I don't recall seeing anything this queer in a long time. I really, really haven't. This is a very unusual performance that makes no sense to me. That's why I said queer. It's not right. Something about this isn't right to me. Well, right to the logic. You know what I mean? Anyway, anybody making any money out of this? Markets are doing some very strange things these days. Also true, Louis. Markets are doing some very strange things. In fact, the fact that they've taken so long, that chart that I showed you of the heat map of the stock market, taken so long to react to what is obviously a highly detrimental situation to the stock market, it would back your position up, Louis. It's a strange thing, that's for sure, and this is a strange reaction. Wow. The reason it's a little strong, we have a strong report. You know, 428, very, it's, 400,000 jobs added. Think of the power and the vigor in the U.S. economy. That is a load of people coming into the workforce. Yet, positions going against the grain beats the hell out of me. I'll give it some time. We're only T plus 4 minutes into this, but the dollar CAD is stabilizing, and it looks like it's going to stick there. The rest of them are in positions of, what I might call contango, but it's just a mixed metaphor. What would not we call this market manipulation? No, Elias, it's not. These markets way, way too big to be manipulated by a single trader or a group of traders. No, I would not call them manipulated. There are signs, by the way, on the graphs you can look at. If you look at the ruble chart, the dollar ruble chart, or the dollar lira chart, or you can see examples of market manipulation by the central banks, but no, these markets are way too deep, way too liquid to be manipulated. Period. Period. No, this is not market. It's weird, but market manipulation is not usually weird. It's usually contrary. This is contrary, but wacky. You know what I mean? It's too. It's these markets too big to be manipulated. Is my answer, sir. Well, ladies and gentlemen, we could sort of hold on. It's like being a little bit at a freak show at a carnival, looking at what's weird happening. I don't know if I don't know how long we'll stick around today's broadcast. I don't see anything tradable happening. And you see what I mean here? There's just nothing here. You know, with these here, where the CAD seems to be strengthening. The yen is strengthening. These are stronger than the lease, which was about here. Why would I trade them? Why would I assume that the yen and the dollar is weakening against these currencies when we clearly had a positive report? Well, let's just take one more look. Unless they're trading the unemployment rate, which is, first of all, it's minimal. Second of all, it's full of shit. The U.S. unemployment rate is notoriously nonsense. It's been adjusted and manipulated so much over the years that it's worthless. The true U.S. unemployment rate is measured in a statistic called U6. U6 is the real unemployment rate, and that's not 3.5. So I doubt that they're trading the unemployment. I don't know what the hell's going on. I freely admit it. Louis asks, "Is there any way to talk with you after this webinar?" You can write to me, Louis. It's in the all the data from the webinar. My address is webinar@alvexo.com, and I will try and my staff will go through the emails, and the ones that are germane I always answer. So feel free to drop me a line, and you can drop it in, you can translate it, no problem. Feel free to write in your native language. Well, it's when I mention those risks, I really don't expect them to happen. To be honest, I don't. I mention them because it's a risk. But when they happen, it's what's the word I'm looking? It's humbling. And to continue, there is no trade for me, ladies and gentlemen. I hope some of you have been able to make some money out of this. If you do, you're better traders than I. And so I think even at this early juncture, at T+8 minutes and counting, I'm going to take my leave because I'm not entering any of these positions. Excuse me, I make notes of me. And I'm going to leave you with that thought because that's the only thought I can share with you. I can't make a nickel out of this, and if some of you can, more power to you. So with that, ladies and gentlemen, the labor market is very tight because of an imbalance between supply and demand, right? Louis says, you bet. You bet. It's not only very tight, it's a serious transition. Labor markets around the world are transitioning from what was to something that we don't really believe in. People left the labor market as a result of the plague. The labor markets are adjusting. Those service jobs that were crummy and poorly paying and now having to pay more. People are getting choosier. Yes, they are in deep transition, for sure. I would say that the numbers weren't great enough and wages were the same as expected, says Elias. Very possible, sir. Very, very possible. I don't have an explanation. But my sense, Elias, is that explanation is simply too deep to consider it, frankly, to explain what's going on here. What goes on here usually is a highly animalistic reaction. It's visceral. It's usually very greedy or very frightening, very fearful. This is neither one of those things. This is some sort of weird Irish jig that I don't get it. And I see it's not going to do anything otherwise. With this, I'm going to take my leave at T+9 minutes and counting. Remind you, please do us all a favor, take a few minutes and fill out the poll and the survey. We'd appreciate that very much. Tune into next week's session on the 12th. It's 1900 GMT. We're going to talk about turning trades into news into trades. And let me say, there is one question here by Benjamin that says, "Thank you, Seth. It's always great working out. I'll keep an eye on this." Wow, thank you for those kind words, sir. Of course, you can't explain irrational human behavior, but the idea behind the report in the market, it was really well explained. Thank you again, sir. I appreciate that. Looking forward to the next webinar, keeping in touch with Alvexo. It's a great deal to me and us as a firm. So, ladies and gentlemen, on behalf of the staff and the management here at Alvexo, I want to wish our clients all I want to thank you all for joining us and gratified for your patronage of us as your online broker. And for those of you who are shopping for an online broker, kindly consider opening an account with Alvexo. We stand up, upright, honest, straightforward brokers. We do the best we can. We don't always make money. We lose plenty, but we do, in the long run, make more than we lose. And that, ladies and gentlemen, is the sine qua non of our business. And so take today's session as a token of the way we behave and act and produce the kinds of things we produce for our clients, and consider opening an account with us. So, ladies and gentlemen, on behalf of the staff and the management here at Alvexo, I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now. Super CISO, always great to have you in the room. My pleasure, sir. Thank you very much for joining us. Good to see you again, Kevin. Thank you very much for joining us. My pleasure. Welcome, Paul, and thank you. How how have those moving? Oh, those moving averages? They are pink is 20, blue is 50, brown is 250. This is 200. 20, 50, 200. All right then, ladies and gentlemen. So take care and have a great weekend. Bye bye for now.